Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on the Economy Show, we have a lot to talk about. We've had, the Fed has come out and made statements. We have rate hikes happening around the world. So the way we're going to break this up to try to simplify it. So we're going to do, the first segment is going to be central banks, rate decisions, growth, global growth, speaking of, and really looking at what is happening on some of the supply chain issues as well. Then from there, we're going to go to US ISM, GDP update, inflation, just general growth, looking at what do we expect to happen throughout Q4, and especially now that we have a lot of data that closed out October. Then in the third segment, we're going to do consumer income, savings, and spending, just to say, okay, well, this is what the government is saying, this is what the corporations are saying, but what is happening at the consumer level, and how is that going to kind of change the way this direction could really travel? And then we're going to do European GDP and inflation, with Italy really kind of being that bright spot at this point. And then China PMI came out, so there's a lot of data to talk about with China, and then some of the prevailing issues that have continued throughout that time period. So we have a lot to cover. We'll try to go as quickly as possible to keep these, at least bite-sized or in a way that we can digest them quickly. So just kicking off, when we look at the global central bank rate decisions, so here, when you look at the composition and pace at the moment, you can see in 2019, again, we were concerned about growth in 2019, as you can see, based on what we've seen so far. So 2019, you had a rate cuts really starting, and then obviously in 2020, you had a big acceleration with 207 cuts. But now in 2021, we've seen 74 rate increases and 10 cuts. And that's going to really kind of continue now with the Fed and what Powell has said. You have the composition and pace. So what we're doing right now, based on the current announcement, is a decrease in the pace of asset purchases by $10 billion in treasuries a month and $5 billion in mortgage-backed securities per month, with the wind down completed in June 2022. So, which is funny because, $5 billion in mortgage-backed securities. So I guess home prices aren't high enough yet. But anyway, when you look at what that also means, is they're really trying to show that they're not going to surprise the market. Not that I think anybody thought it was going to be surprised. This was very much consensus in terms of what he was saying. And they've also changed the way they're describing inflation as transitory. Now it's uncertainty of transitory, because it's going much harder and faster than they were expecting, which in my opinion surprises nobody, but again surprises them. So I think when you look at what is happening right now, there is going to be this fear about, okay, well, does this mean that they're going to have to accelerate their stimulus cut because the inflation is just going to continue to run well ahead of them? So I think those are going to be some of the concerns as we continue forward. And then the idea is that you're going to get at least two rate hikes next year. But how are you going to hike rates while you're also printing? Again, this is where you get some of this convoluted nature in what is happening within the U.S. But the market obviously likes it. As we all know, anything that is consensus is never baked in. So the market is now currently up 23 handles on the announcement after being down about 6. So you almost have a 28 to 30 handle reversal on this current announcement coming from the Fed. But then when you look at South Korea's inflation is running very hot. So there is a view that you'll see another rate increase coming out of South Korea as well. Now, when you look at manufacturing PMI, a lot of the things that we've been talking about and really been trying to drive home is that we continue to see an increase in activity on the manufacturing side, especially when you look at Asia. So Asia's been a big driver of it, and one of the things that they've been coming out of their lockdowns, which has been a big benefit for where things are going. But when you look at manufacturing PMI, you also have to appreciate how it's calculated, and some of the pieces that make up the calculation are actually have an underlying negative impact on the economy. And that's when you look at things from the perspective of supply chain, price inputs. Some of those components are on a negative side. Now they're still in growth, but again, that kind of brings back where some of these things are in terms of growth and what that means going forward. Myanmar is one that has obviously seen some contraction, and the ASEAN countries have really shunned Myanmar based on the issues that are happening there with the recent coup, and then the amassing troops in some questionable places that is becoming a bit of a concern that there might be a more military drive. So this gives you some of that summary of where that growth is, and then when you look at the regional backdrop on a world level, looking at September, the regional PMIs averaged about 54.3 when you look at the world. Then when you look at the U.S., there was a small backdrop to 60.8 in September, and into October. And then when you look at the Eurozone, you had some of that pare back. Japan had a little bit of a recovery, which is positive. China, a bit of a slowdown. India came back strong, but inflation is starting to pick up, so that's going to be one to watch as we start looking at what the RBI is doing, and especially when we see what India has done, which was actually cut some pricing on diesel and gasoline. So then when we start looking at the foreign holders, because as inflation becomes a bit of a concern, this is where you start to see some additional paper getting purchased as companies and countries look to try to mitigate against inflation and protect their local currency or their local balance sheet by purchasing additional dollars, or in this point, U.S. Treasuries, which are treated very similar, just given their overall view in the market as a safety asset, and then it throws off cash. So it throws off U.S. dollars. So why not buy that? And then you can obviously continue to take in some additional dollars off the back end of it to increase your dollar holdings. But then when you look at the supply chain as the common theme, again, coming back to that those PMI numbers, when you look at what are some of the biggest drivers of it, well, clearly when we look at commentary and keywords pulled out of earnings, here you can see obviously inflation is a big and ugly one that continues to come up, as well as supply chain. So supply chain, shipping, input costs, again, all of these things that have a positive contribution to the PMI number is actually a negative when you look at underlying corporate earnings, margin. So there's always something to be accounted for. Now, if you back out a lot of these negative things, we're still in an expansionary territory. It's just much closer to that 51 to 53, not this great 56 to 60. So again, there's some of that balancing that we have to look at when we're projecting out what is GDP going to look like, how is global growth going to go, because some of these may look good on some of the leading indicators, but actually have a negative impact when we start factoring into how will that drive the economy going forward, which is then when you look at selected countries' commodity price. So when you look at commodity price surges, increase in real prices, when you look at Nigeria, Ukraine, Vietnam, Ghana, Uzbekistan, it's all driven based on what we're seeing on commodities. And that is, I think, a bigger and bigger issue and fear when you're looking at how prices are surging and the share of staple in the food consumption basket. You're just looking at how these prices continue to pull that basket up and make it more and more damaging. So then when you look at food staples, contribution to CPI inflation, median by income. So when you look at the low income countries, the low to middle income countries, you can see just how bad some of these impacts are, what these impacts have, and how they really carry out and drive some of these underlying problems. And CPI, again, is not going away. And especially when you look at the emerging markets, because you're going to feed their families, and they're going to try to find ways to feed their families. So Bangladesh just took gasoline prices up 23%. All of these are extremely negative when you look at that underlying backdrop of spending, of how are they going to continue to consume, because again, these pressures are real and in the system. And then consumer price inflation by country and group. So when you look at just where this CPI, so CPI at emerging markets has been essentially a hockey stick on the way up. And then when you look at the advanced economies, everything is being pulled higher. And it's really being led by these low-income developing countries, these emerging markets, and you're seeing all of that being pulled up. And again, there's none of this that is going to drop. And when you look at what the Fed is doing, how the actions are going, this is only going to continue to get worse as we have just more and more money sloshing around, continuing some of these pressures to the upside. And because of this inflationary backdrop, the value of negative yielding global debt is hovering at the lowest since June 2020. As you can see, again, people are pricing in more inflation, and that is driving some of these yields back above into positive territory. But then when you look at the cumulative excess of savings, now this is as of Q1 2021, so we know that there has been a drawdown in this, especially in the US, but you get an idea of where we started. Because all of this money, well, I shouldn't say all of it, a lot of this money has already been pulled into the system because we're now in Q4 of 2021, and a lot of this capacity, this spending has been pulled out because you've had these price increases. So people were able to weather the inflationary pressures better than what they were initially able to, again, helping some of this underlying backdrop and providing some of the support. But these, again, are things that have now run its course. You've seen a lot of this get pulled out. But what comes next? What is the next incremental driver as we not only head into the end of Q4, but also into Q1 2020? And this is just showing the supply chain disruptions across the board. The containerized cargo index, the Euro area, US, China, all of these things driving that inflation, and again, bringing down and pulling out some of these savings that have been put into the market. And supply chain disruptions, the Google search trends is obviously here. So this is not just a US issue. This is a global problem, which is why we have to think about this on again, throughout the whole supply chain, not just one piece of it, because you're just seeing the issues remain in one area and flow all the way down, creating some of these problems. So then when you look at just who is having some of these bigger issues, well, the U.S. is essentially at the tip of the spear in terms of those problems, but the input cost price has been able to be passed on. The output price, when you look at where things are, the U.S. has been able to pass on more than most, but a lot of areas are starting to catch up, which is why we continue to see these problems that are cropping up on the inflationary cycle, because all of these prices, I mean, look at the U.S. with output prices, like it's just straight up. Like there hasn't even been any sort of real slowdown, which again, just showing who is going to be responsible and how this is getting passed on over this time period. So when you look at the U.S. outlier status on supply disruptions was clear back in March of 2021 when markups on output versus input prices and delivery delays. But what made the U.S. an outlier in March 2021 is the same as in October. But again, you're just seeing other countries now seeing something similar. So you just see that U.S. was the driver, the U.S. was there, and now everybody is really starting to come up and just see how those input prices have really driving and supporting where inflation is. But then when you look at memory chip prices, so some of this is starting to slow. So you're starting to see some of these, come down a bit. So the memory chip prices are softening, DRAM spot prices. So this is going to be some normalcy. You'll see some of this be a little bit beneficial as we go forward, which again is something that will be a net positive just to offset some of what we've seen and get some normalcy back into it. But you can see just how far we are off that low. So even the price drops we've seen still put us in a very elevated point. But the other side is some of the prices on freight benchmark rates on the container side, as well as on dry bulk, have come down, which have also brought some prices down. But just look at where we sit. They're still at 2021 elevated levels. They're not at the highs, but they're still well above where they were in 19, 18, and obviously in 20, keeping some of those inflationary pressures, well founded. But this is where we see this big disconnect, because PMI new orders fell further into contraction territory this October, coming in at 48.8 versus 49.3 in September. This is one of several inputs that is used to come through this. But then when you look at the commodity spot index, so the commodity spot index has continued to go up while commodity fair value index has continued to come down. And you're looking at this bifurcation in the market, which again, we've seen deviations before. And now the question is, when do you see that normalcy? And you can see that there's a huge alligator mouth that at some point you will see this collapse. It's just how quickly and what will be the impetus to see some of that drop. And then when you look at, well, let's look at grain. So U.S. wheat winter conditions, for October 31st, percent poor versus very poor. Going back to 1986, this is the most that is either poor or very poor, with 2020 being the second highest. So again, you're seeing 2 years back to back of problems, which creates those issues. And then U.S. winter wheat conditions, October 31st, good to excellent. This is one of the lowest percentage of good to excellent. So you're seeing the problems in the U.S., which is the wheat is obviously a big crop for the U.S., and this is an underlying pressure that continues to reign free throughout the system with crop progress. So corn, 74% harvested, fairly in line with what expectations were. Soybeans, 79% harvested, a little bit slower, but again, right there. Cotton getting a bit better. Winter wheat, 87% planted, right where where it should be expected. 67% emerged, but 45% good to excellent. So again, you're seeing planting is there, emerge is fairly in line with what the average is. It's just the quality of it so far is the underlying problem. Now we have had a increase in exports. So corn coming in at 619 last week, slightly below. Soybeans, something similar. We've actually had an increase in some exports going into China for the soybean side. And then wheat has slowed down considerably. And it's really coming down to the fact that we just don't have the pricing at this point because volumes continue to fall off, and that's going to keep a certain amount within the U.S. And then another week of elevated export inspections for the U.S. and soybeans, which is expected this time of year. It's just when you look at what China has done, they've come in and has started buying a bit more. Then what is this doing? When you look at wheat, when you look at corn, when you look at grains in general, breakfast prices are the latest sign of hot global inflation. When you look at how this continues to go up in lockstep, and this is going to be a big driver. But then when we look forward, that's when we start looking at fertilizer worries. So price of ammonia in Western Europe hit a 13-year high. So again, farmers are buying now for what they need next year. And you can only wait so long because what if there isn't any available? How is that going to be? What is that going to be a big problem on? And this is where when you look at 2022, you're going to see more problems in that area and how these issues are going to continue in the region. With fertilizer spikes in North America, when you look at nutrient all-time high. When we look at how these agricultures are, and the agriculture fund versus the Tampa ammonia spot price, you get an idea of just how disconnected, but yet they're typically very close to each other. So again, that's some of this alligator mouth that we've been talking about in terms of seeing some of these catch-ups. Now, then when we look at coal in the U.S., this is a bigger issue as coal inventories are falling in the U.S. power plants. The hope is to try to close some of this gap before we get into winter, because obviously a lot of individuals in the U.S. have electrification for heating, which means that as we go into winter, we'll get a bigger pull on underlying electricity. Now, one of the things that China has said is that they're going to be increasing the amount of nuclear reactors that they operate with. And I just want to take a moment and talk about the molten salt reactor or the thorium. So when you look at the salt reactor, the way it works is, in a molten salt nuclear reactor, the fissile material is dissolved in liquid salt in the reactor core. Liquid salt also acts as a coolant in place of water. It insulates better, it cools off better. So there's something to be said about that. Fission also occurs in the reactor core, generating heat, which is transmitted by the coolant salt and heat exchangers to water, producing steam, and then this drives a turbine to generate electricity. A frozen plug of salt melts if the reactor core overheats, allowing the fuel salt mixture to drain into emergency dump tanks. So you get an idea of some of the fail-safes, some of the issues. Obviously, it's salt. You have a concern for corrosion, so that those are things that have to be mitigated, but you're not using the same type of uranium. You have much less negative output in terms of damaging radioactivity. There's a lot of benefits when you look at this. The first one is now operating in China. I think this is going to be of great interest to see, because this nuclear still remains the number one way to have zero carbon emissions, limited greenhouse gas emissions for what power is produced, because there's a huge, obviously, power output. So this is going to be, I think, an important one in the environmental case. How is this going to play out? Because I think this is going to be a one that I think we should study more aggressively. Then there's obviously micro reactors, small reactors, the pebble reactors. There's going to be options for us. It's just we have to get out of our own way a bit and push some of these through to understand. Obviously, push them through within reason. We have to be very cognizant of how are they built structurally. But these are I think much easier ways to solve some of these problems that we've seen on the greenhouse gases side. So that's what we have for you on the global front. Now on the next segment, we're going to go much deeper into the U.S. data sets and what we expect to happen over the next two segments.